You see, what's going on so far in this country is a legal and financial storm forming over several years, finally tightening into something clearer. And I've seen storms before: market crashes, financial crises, political upheavals that shook businesses to their core. But this one's different because it's not hitting all at once. It's building layer by layer, pressure point by pressure point. And the truth is, you do not need to be a lawyer or an economist to understand what it means. You really don't. I've spent my whole life trying to make complex things simple, trying to cut through jargon and get to what actually matters. And what matters here isn't the legal terminology or the political spin. It's the practical reality of how these situations affect real businesses, real decisions, real money. You only need to look at what the courts have actually said, what penalties still remain, and how those decisions affect the way businesses operate in the real world. Not what pundits predict, not what anonymous sources claim, not what's trending on social media, just the documented facts, the official rulings, the things you can verify yourself by reading court records. And this is important because in today's media environment, there's so much noise, so much speculation, so many people with agendas trying to spin things one way or another. You've got to learn to filter that out, to focus on what's actually documented, what's actually been decided by courts with the authority to make those decisions. So let's start there. Let's start with the fact. In New York, a judge ruled in early 2024 that Donald Trump and his company committed business fraud by overstating the value of several real estate assets. Now, this wasn't a close call. This wasn't a maybe they did, maybe they didn't situation. The judge looked at the evidence, examined financial statements, heard testimony, and concluded that yes, valuations were inflated, properties were represented as being worth more than they actually were. The case itself was brought by New York Attorney General Letitia James, who spent years investigating the Trump Organization's business practices. She looked at how they valued properties when seeking loans, how they valued the same properties for tax purposes, and found what she considered to be significant discrepancies. Properties would be valued one way to get favorable loan terms, then valued very differently when it came time to pay taxes. That kind of inconsistency raises red flags for any financial regulator or prosecutor because it suggests the valuations aren't based on objective assessment of what properties are actually worth, but rather on whatever number benefits the company in that particular situation. The size of that original penalty was enormous. I mean, truly enormous. About $454 million plus interest. When you add the interest component, you're talking about a number that would crush most businesses, even large ones. Think about what $454 million represents. For context, that's more than the annual revenue of many Fortune 500 companies. That's the kind of number that can fundamentally alter the trajectory of an organization, force asset sales, require massive restructuring. People focused on that headline. It looked historic. It was historic. You don't see fraud penalties of that magnitude very often, even in major corporate cases. I've been around long enough to remember some of the biggest corporate fraud cases in American history. Enron, WorldCom, the financial crisis cases against major banks. Even in those situations where you had massive fraud affecting millions of people, destroying billions in shareholder value, the individual penalties rarely reached this level. So when this number came out, everyone in the business and legal world took notice. This wasn't just another case. This was potentially setting a new standard for how aggressive prosecutors and regulators could be in pursuing what they considered business fraud. So the news cycle went crazy. Everyone talked about how this was a crushing blow, how the company couldn't possibly survive, how everything was falling apart. Financial analysts started speculating about bankruptcy, about forced asset sales, about the potential dissolution of the Trump Organization. Real estate experts weighed in on which properties might have to be sold to raise cash. Legal experts discussed whether the penalty could be reduced on appeal, what the timeline might look like. whether there were any legal mechanisms to delay payment while appeals were pending. But here's where the story gets more complicated, more nuanced than those initial headlines suggested. In August 2025, a New York appeals court threw that financial penalty out, just eliminated it, said it was excessive under the Constitution. The Eighth Amendment prohibits excessive fines, and the appeals court looked at that $454 million figure and said, no, this crosses the line. This is too much. Now, this is where legal principles come into play that most people don't think about very often. The Eighth Amendment, which most people associate with cruel and unusual punishment in criminal cases, also applies to civil fines and penalties. Courts have recognized that the government can't impose penalties that are so disproportionate to the offense that they effectively become punitive beyond what's reasonable. There has to be some relationship between the harm caused by the misconduct and the penalty imposed. And the appeals court concluded that relationship didn't exist here, that the penalty was excessive relative to the actual harm proven in the case. Now, some people thought that meant the whole case was gone. They saw appeals court throws out penalty and figured it was a complete victory. Case closed. Everyone moves on. And you could understand why they'd think that. If the penalty is gone, what's left? The whole point of the case was the financial consequence, right? If there's no money that has to be paid, then effectively the prosecution failed, didn't it? But the appeals court did not overturn the fraud finding. And this is crucial. This is where a lot of people get confused or miss the significance. In fact, they upheld it. They said, yes, the fraud happened. Yes, the valuations were misleading. Yes, the judge was right about the underlying conduct. We're just saying the punishment was too severe. And that matters because it means the court still believes the valuations were misleading. It means there's now a judicial finding on the record confirmed on appeal that says this company engaged in fraud. Not alleged fraud, not accused fraud, adjudicated fraud. That's a finding that has legal consequences beyond just the immediate case. Think about what it means to have a fraud finding on your record. Every future business transaction, every loan application, every partnership agreement, every insurance policy, all of it gets evaluated in light of that finding. When you're negotiating with a bank for financing, they're going to look at your history. When you're trying to attract investors or partners, they're going to do due diligence. And now, prominently in that history, there's a court finding of fraud. That doesn't just disappear because the financial penalty was thrown out. Now, from a purely financial standpoint, not having to pay $454 million, that's obviously better than having to pay it, no question. The company doesn't have to come up with that cash, doesn't have to sell assets, doesn't face the immediate financial crisis that would have resulted. From that narrow perspective, the appeals court ruling was a significant win. But from a business operations standpoint, from a how does this affect the company going forward standpoint, that fraud finding creates problems that are different from a financial penalty, but potentially just as significant over the long term. They also left something in place that is more unusual than a fine, a court-appointed monitor with the authority to watch how the business makes big decisions, how it borrows money, and how it reports its numbers. Let that sink in for a moment. A court-appointed monitor, someone who's not part of the company, not chosen by the company, but imposed by a court to oversee operations. That kind of supervision is rare for a private enterprise of that size. I've been around business for over 70 years. I've seen companies face all kinds of penalties, restrictions, settlements. I've seen regulatory oversight, consent decrees, settlement agreements that impose operational requirements. But having a court-appointed monitor watching your every move, that's unusual. That's typically what you see in extreme cases where courts don't trust the company to operate properly without oversight. You see it sometimes in organized crime cases where courts believe a business has been so thoroughly corrupted that it needs external supervision to ensure it operates legally. You see it in some environmental cases where companies have repeatedly violated regulations and courts impose monitors to ensure compliance. But for a case like this, for a civil fraud finding in a business valuation dispute, having a monitor imposed is significant. If you run a business, imagine having a referee standing over your shoulder every time you want to take out a loan, sign a major contract, or revalue an asset on your books. Think about what that means in practice. You want to refinance some debt to take advantage of better interest rates. You've got to explain it to the monitor. You've got to provide documentation showing why you think the refinancing makes sense, what the terms are, how you're valuing the assets being used as collateral. And the monitor has the authority to question your assumptions, to challenge your valuations, to potentially block the transaction if they believe it involves the kind of conduct that led to the fraud finding in the first place. You want to acquire another property and you're stating what you think it's worth. The monitor is reviewing that valuation. They're looking at your comparables, your projections, your assumptions about future rents or development potential. They're asking questions. Why do you think this property is worth this amount? What data supports that valuation? Are you being consistent with how you value similar properties? Are you being conservative or aggressive? And if they're not satisfied with your answers, they can raise objections, they can require additional analysis, they can potentially prevent the acquisition from moving forward. You want to present financial statements to a potential partner or investor. Those statements are being scrutinized by someone whose entire job is to make sure you're not doing what you were found to have done before. Every number is being checked, every assumption is being questioned, every representation is being verified, and that takes time, it adds friction to the process, it creates uncertainty about whether deals can actually close on the timeline you need, ownership stays with you. Yes, the company is still yours. You still control it in theory, but the room to maneuver becomes smaller. The flexibility that business owners typically have to make quick decisions, to pivot when opportunities arise, to structure deals in creative ways, that flexibility is constrained. That is the real consequence of the New York case. And this is what a lot of people miss when they focus only on whether there's a financial penalty or not. Not a single crushing bill that you write a check for and it's over, but a long, steady constraint that affects every big decision the company tries to make. It's like, imagine you're driving a car, but there's a governor on the engine that won't let you go above 50 miles an hour. Can you still drive? Sure. Can you get where you're going? Eventually, but you're operating under a handicap that your competitors don't have. And over time, that adds up. When you're trying to compete in real estate, when you're trying to make deals, when you're trying to grow and operate and respond to market conditions, speed and flexibility matter enormously. Being able to move quickly when an opportunity presents itself, being able to structure financing in the most advantageous way, being able to present your strongest case to lenders and partners, all of that matters. And when you've got a monitor looking over your shoulder, when you've got a fraud finding on your record, when banks and insurance companies are factoring all of this into their risk assessments, everything becomes harder. Your borrowing costs go up because lenders see additional risk. They look at the fraud finding and they think, well, if the courts determined that this company was inflating valuations, how can we be confident in the valuations they're presenting to us now? Maybe we need to discount their representations by some percentage. Maybe we need to require more collateral to compensate for the uncertainty. Maybe we need to charge a higher interest rate to reflect the additional risk we're taking. Your insurance premiums increase because insurers are worried about their exposure. Directors and officers insurance, errors and omissions coverage, general liability policies, all of it gets repriced based on the new risk profile. Insurance companies look at the fraud finding and they think about potential future claims, about lawsuits from business partners or investors who might claim they were misled, about regulatory actions that might be coming, and they adjust their premiums accordingly. Potential partners become more cautious because they're concerned about being associated with a company that's been found to have engaged in fraud. Reputational risk is real. If you're considering a joint venture or a partnership with a company that has this kind of finding on its record, You have to think about how that association might affect your own reputation, your own relationships with lenders and investors and customers, and often the safe thing to do is just to walk away, to find a different partner without that baggage. None of this shows up as a single dramatic headline. It's not like one day the company collapses. It's more subtle, more gradual, but the cumulative effect over months and years can be just as significant as a one-time penalty. It's death by 1,000 cuts rather than one dramatic blow. And from a business perspective, sometimes that's actually harder to deal with because there's no single moment where you can address the problem and move on. It's just this ongoing drag-on operations that persists indefinitely. And here's something else people don't always appreciate. When you're operating under this kind of oversight, it's not just the practical constraints, it's also the psychological impact, the stress of knowing that every major decision is being scrutinized, the time and energy that gets diverted from business operations to dealing with the monitor, providing documentation, explaining decisions, responding to questions and concerns. I've run businesses for decades. I know what it's like to have to answer to shareholders, to boards, to regulators. That's part of doing business. You have oversight, you have accountability, you have people who have the right and the responsibility to question your decisions. But having a court-appointed monitor, that's a different level of intrusion. That's someone who's there specifically because a court doesn't trust you to operate properly on your own. And that message, that lack of trust, it permeates everything. It affects employee morale because people wonder about the stability of the company. When there's a court-appointed monitor overseeing operations, employees start asking questions. Is the company in trouble? Is my job secure? Should I be looking for other opportunities? And even if management tries to reassure everyone that things are fine, the presence of the monitor sends a different message. It creates uncertainty and anxiety that affects productivity and retention. It affects recruitment because top talent might be hesitant to join an organization under that kind of supervision. When you're trying to hire experienced executives, skilled professionals, people with options about where they work, the court monitor becomes a red flag. Why would someone leave a stable position to join a company that's operating under court supervision because of a fraud finding? What does that say about the company's culture, its leadership, its future prospects? It makes recruiting harder, and in business, having the best people is often what separates success from failure. It affects the company's reputation in ways that are hard to quantify, but very real. Reputation is built over years and can be damaged in moments. Once you have a fraud finding attached to your name, to your company's name, that follows you. It shows up in news articles, in Google searches, in due diligence reports. It becomes part of the permanent record, part of how people perceive and evaluate the organization. And changing that perception, rebuilding that reputation, that takes years of consistent good behavior, of transparency, of demonstrating that the problems that led to the fraud finding have been addressed and won't happen again. So when people ask, what's the actual impact of the New York case, the answer isn't simple. It's not just they don't have to pay the fine so they won. It's more like they don't have to pay the fine, but they're operating under significant constraints that will affect business decisions for years to come. And they're doing so with a fraud finding on the record that will color how everyone, from banks to business partners, views them. That's the reality. That's what the facts show. Not speculation, not political spin, just the practical consequences of what the courts have actually ruled. And this is just one piece of the puzzle because while the New York case was playing out, other things were happening. Other investigations, other legal pressures, other situations developing that create additional layers of complexity. When you're managing a business under normal circumstances, you make decisions based on economic factors, market conditions, competitive dynamics. You look at supply and demand, you analyze your competition, You evaluate opportunities and risks based on business fundamentals. But when you're managing a business under this kind of legal pressure, every decision has to factor in potential legal implications. Every move has to be considered through the lens of how will this look to the monitor, to the courts, to prosecutors who might be watching. Will this transaction raise questions? Will this valuation be challenged? Will this decision be second-guessed by people looking for evidence of ongoing misconduct? That changes the calculus. It slows things down. It adds friction to every transaction. And in business, friction costs money. Every delay, every additional layer of review, every moment of uncertainty, that all translates into real economic costs. Deals that might have closed quickly get delayed while you navigate the oversight process. Opportunities that require fast action get missed because you can't move quickly enough. Potential partners get frustrated with the complexity and choose to work with someone else. It all adds up. Delays cost money. In real estate, timing is often everything. Property markets move, interest rates change, opportunities appear and disappear based on specific market conditions at specific moments. When you're operating under constraints that slow down your decision-making, you miss opportunities that more nimble competitors can capture. You can't be as responsive to market conditions as you need to be to maximize returns. Reduced flexibility costs money. The ability to structure deals creatively, to find innovative solutions to complex problems, to pivot when circumstances change, that's valuable. That's often what separates great businesses from merely good ones. When your flexibility is constrained by oversight and regulatory concerns, when you have to fit every decision into a narrow set of approved approaches, you lose that competitive advantage. You become more predictable, more conventional, less able to create value through creative structuring and innovative thinking. Even if you can't put an exact dollar figure on it, the impact is real and substantial. This is what accountants call opportunity cost, the value of what you could have done but didn't because of the constraints you're operating under. It doesn't show up on a balance sheet as a specific loss, but it's real nonetheless. It's the deals you didn't make, the opportunities you couldn't pursue, the growth you didn't achieve because you were operating under these restrictions. And then you have the Georgia case. Now, this one's interesting because it follows a similar pattern to New York, but in a different jurisdiction with different legal mechanisms at work. Early in 2024, Judge Scott McAfee dismissed 6 counts, including 3 involving Trump himself. And when that happened, the headlines were immediate. Charges dismissed, case falling apart, all the usual reactions when a judge throws out part of an indictment. He said the charges lacked enough detail to meet legal standards, which is a technical procedural issue. Basically, the prosecutor didn't provide enough specific information in the indictment for the defendant to properly prepare a defense. The charges were too vague, too general. That's a legitimate legal problem, and judges are supposed to catch that kind of thing. The constitutional right to due process includes the right to know exactly what you're being accused of, what specific acts you allegedly committed that violated what specific laws. When an indictment is too vague to provide that information, it's defective and has to be dismissed. Later in September 2024, he dismissed 3 more counts, 2 of them tied directly to Trump because of a conflict with the Supremacy Clause. Now, for people who aren't lawyers, that might sound like legal gibberish, but it's actually pretty straightforward. In simple terms, he said certain state charges could not apply when they overlapped with federal processes. The Supremacy Clause in the Constitution says that federal law trumps state law when they conflict. So if Georgia is trying to charge someone for actions that involve federal officials performing federal duties, there's a legal problem there. The state can't necessarily prosecute conduct that's protected or governed by federal law. This is actually a fundamental principle of our constitutional system, the division of power between federal and state authorities. There are some things that states have authority over, some things that only the federal government can regulate, and when those spheres overlap, federal authority prevails. But again, the headline did not tell the full story. And this is becoming a theme, isn't it? The surface-level news, the quick reaction, the Twitter-length summary, they all miss crucial details. Those dismissals did not clear the entire indictment. They got rid of some charges, sure, important charges directly involving Trump, but they didn't make the whole case disappear. The racketeering or RICO case still stands, and RICO, well, that's a different animal. RICO cases are about patterns of behavior, about coordinated actions by multiple people working together. They're complicated, they're sprawling, and they don't necessarily fall apart just because some individual counts get dismissed. The Racketeer Influenced and Corrupt Organizations Act was originally designed to prosecute organized crime, the mafia, criminal enterprises, but over the years, it's been applied more broadly to any situation where prosecutors can show a pattern of illegal activity conducted through an organized structure. RICO cases are powerful prosecutorial tools because they allow prosecutors to connect various individual acts into a broader narrative of organized criminal conduct. Even if some specific acts don't result in charges, or if some charges get dismissed, the overall pattern can still support a RICO prosecution. It's about the forest, not just the individual trees. And that makes RICO cases particularly difficult to defend against, particularly hard to get dismissed entirely, because as long as prosecutors can show enough of a pattern, enough coordination, the case continues. Other felony charges still stand. The prosecution still has a case. It's a narrower case than they started with, but it's still very much alive. The legal fight is not over. It has simply changed shape. And you know what? That's how legal cases often work. They evolve. They get refined through pretrial motions and judicial rulings. Charges get added. Charges get dismissed. The battlefield shifts. But the war continues. Any experienced litigator will tell you that cases rarely proceed exactly as filed. There's a whole process of motion, practice, discovery, legal arguments about what evidence is admissible, what charges can proceed, what legal theories are viable. Cases get narrowed, they get focused, they get reshaped based on how judges rule on various pretrial issues, and that's actually how the system is supposed to work. Courts are supposed to weed out weak charges, ensure that prosecutions are based on proper legal grounds, protect defendants' rights to due process. And when you step back, when you look at the bigger picture beyond just Georgia or just New York, what you see is not just one case or one set of charges. You see something larger. You see a growing tension between political actors, state institutions, and the financial world that depends on consistency and predictability. Courts limiting executive actions. We're seeing judges push back on claims of absolute authority, setting boundaries on what can and can't be done even by powerful political figures, regulators pushing back on valuations, financial regulators, tax authorities, compliance officers. They're all looking more closely at how assets get valued, how numbers get reported, whether the representations being made match reality. States asserting their authority, Georgia, New York, other states saying, we have our own laws, our own jurisdiction, our own ability to prosecute conduct that happens within our borders. Business monitors gaining power, not just in this one New York case, but as a mechanism courts are increasingly willing to use when they don't trust businesses to self-regulate. Appeals courts narrowing penalties, but confirming misconduct. We're seeing this pattern where the dollar amounts get reduced, but the underlying findings of wrongdoing stand, which is actually a more complicated outcome than a simple win or loss. These things add up. They create a landscape that's more complex, more regulated, more scrutinized than what we've seen before. And that complexity has consequences. For a regular person, all of this can feel distant. I get it. You're not running a real estate empire. You're not facing fraud charges. You're not dealing with court-appointed monitors. So why should you care? But it reaches them. No doubt. These things ripple outward in ways that affect everyday people, everyday businesses, everyday economic activity. It reaches them when lenders become more cautious. When banks look at all this legal uncertainty and they tighten their lending standards, when they require more documentation, more collateral, higher interest rates to compensate for the increased risk they perceive, that affects not just the people directly involved in these cases, but anyone trying to borrow money for a business, for a home, for anything. If you're a small business owner trying to get a loan to expand your operations, you might find it harder, more expensive, more time-consuming because banks across the board have become more risk-averse in response to high-profile cases like these. It reaches them when businesses deal with higher compliance costs. When companies see what's happening in high-profile cases and they decide they need to invest more in legal review, more in accounting oversight, more in making sure every valuation can be defended in court, those costs don't just disappear. They get passed on to consumers, to employees, to shareholders. When a company has to spend more on lawyers and accountants and compliance staff, that money comes from somewhere. Either prices go up, or wages are lower than they would otherwise be, or returns to investors are reduced. The money doesn't just materialize out of thin air, it reaches them when markets pull back because they can't price risk clearly. And this is the part that really matters from an investment standpoint, from an economic standpoint. Market confidence is not built on volume. It's not built on activity or excitement or people making lots of transactions. It is built on clarity, on the ability to understand what the rules are, what's likely to happen, what the range of possible outcomes looks like. And clarity is exactly what gets strained when institutions collide. When you've got courts and regulators and state authorities and federal authorities all pushing in different directions, all asserting different forms of oversight, all creating different requirements and standards, it becomes hard to know what the rules actually are. If you're a business trying to make long-term plans, how do you factor in the risk that something you thought was acceptable business practice might later be deemed fraud by a court? How do you price that uncertainty? How do you plan around it? You can't really, or you can, but you do it by being more conservative, by adding bigger margins for error, by pulling back from things that might have risk you can't quantify. And when everyone does that simultaneously, when the whole market becomes more risk-averse because of uncertainty, that slows economic activity, that reduces investment, that makes everyone a little bit worse off. Not in a dramatic, obvious way, but in subtle ways that compound over time. Growth is a little slower, job creation is a little weaker, wages rise a little less than they otherwise would have. The economy still functions, but it functions below its potential because of the drag created by uncertainty. If you want an example of why this sort of thing matters, look at real estate valuation. This is something I understand pretty well, having spent decades looking at property investments, analyzing what things are worth. Real estate has always lived in the space between art and science. You can't value a property with mathematical precision the way you might value a bond. There's judgment involved, there's interpretation, you estimate market rents. What might someone pay to lease this space in the future? Well, it depends on the market, on the economy, on what's happening in the neighborhood, on a dozen other factors. You make your best educated guess. You look at current rents for comparable properties, you think about trends, about whether the area is improving or declining, about new development that might be coming, about transportation changes that might affect desirability. All of that goes into your estimate, and reasonable people can disagree about what the right number is. You estimate future development. Could this property be worth more if you renovated it or built something new or changed its use? What would that cost? What would the improved property be worth? Again, these are estimates, projections, informed guesses. You're trying to envision what doesn't yet exist and put a value on it. That inherently involves uncertainty, involves assumptions about costs and timelines and market conditions and regulatory approvals. Nobody can predict the future with perfect accuracy. You compare buildings to others. You look at what similar properties sold for recently, but no two properties are exactly the same. So you adjust for differences, and those adjustments involve judgment. This building is bigger, so it should be worth more, but it's also older, so maybe worth less. It's in a better location, but it needs more work. How do you weight all those factors? There's no formula that spits out the exact right answer. You use your experience, your knowledge of the market, your judgment about what matters most. There is room for optimism, always has been. Real estate investors tend to be optimistic by nature. They look at a property and they see potential. They project growth, improvement, appreciation, and sometimes they're right and they make money. Sometimes they're wrong and they lose money. That's business. That's the nature of investment. You make the best judgment you can based on available information, and then the market ultimately tells you whether you were right or wrong. But the New York ruling shows something new, something that changes the calculation that courts may treat overly optimistic valuations as legal liabilities, not just business plays. That is a major shift. In the past, if you valued your property aggressively and it turned out you were too optimistic, the consequence was economic. You might not be able to sell it for what you thought. You might not be able to rent it for what you projected. The market would correct your mistake. You'd lose money on the deal, learn from the experience, adjust your approach going forward. That was the penalty for being too optimistic, economic loss. But now we're seeing that if your valuation is deemed too aggressive, too optimistic, insufficiently supported by the facts, it might not just be a bad business decision. It might be fraud. It might subject you to penalties, to oversight, to legal consequences beyond just losing money on the deal. That changes everything. It changes how people approach valuations. It makes everyone more conservative, more cautious, more focused on being defensible in court rather than maximizing the presentation of value. Is that good or bad? Well, it depends on your perspective. If you're concerned about fraud, about people lying on financial statements to get loans they shouldn't get, then maybe it's good. More accountability, more honesty, less tolerance for playing fast and loose with numbers. From that perspective, the New York case represents appropriate enforcement of standards that should have been enforced all along. But if you're concerned about economic growth, about entrepreneurship, about people being able to take calculated risks and pursue opportunities, then maybe it's concerning, because when the line between optimistic business judgment and potential fraud becomes blurry, people get scared. They pull back. They don't pursue deals they might otherwise pursue. And the real estate market, well, depends on people being willing to make deals, to invest, to develop. When that slows down because of legal uncertainty, the effects spread throughout the economy. Construction slows, jobs are affected, property tax revenues decline, the ripples go everywhere. Real estate isn't just about buildings. It's about construction workers and architects and engineers and all the businesses that supply materials and services to the industry. It's about the restaurants and shops that serve the people who live and work in those buildings. It's about the tax revenue that funds schools and infrastructure. When real estate development slows, the impact touches almost every part of the economy. So when I look at these cases, when I look at the legal developments we're seeing, I'm not just thinking about the individuals involved or the specific charges. I'm thinking about what it means for how business gets conducted, for how markets function, for whether we're moving toward more clarity or less clarity in terms of what the rules are. And right now, honestly, we're in a period of less clarity. We're in a period where old assumptions are being challenged, where practices that were once considered normal business conduct are being re-examined, where the boundaries of what's acceptable and what's potentially criminal are being redrawn. That's uncomfortable for businesses, for investors, for anyone trying to plan for the future. But it's also potentially necessary if the old system wasn't working, if people were genuinely abusing it in ways that needed to be addressed. The question is whether we'll emerge from this period with clearer, better rules that everyone understands and can operate under, or whether we'll end up with a patchwork of confusing, contradictory standards that vary by jurisdiction and make it harder for legitimate businesses to operate. Will we get smart regulation that protects against genuine fraud while still allowing legitimate business activity? Or will we get a system where everybody's terrified to make any decision because they're not sure whether it might later be deemed illegal? That's the fundamental question, and honestly, we don't know the answer yet. We're still in the middle of this transition, still figuring out where the new lines are, still waiting to see how courts in different jurisdictions apply these emerging standards to different fact patterns. That's why I keep emphasizing the importance of focusing on what we actually know, on documented facts, on official rulings, rather than speculation about where things might go. For the ordinary investor, the lesson is simple. And I mean truly simple, not the kind of simple that requires a PhD to understand. When noise rises, stay close to the basics. When everyone's screaming, when headlines are flying, when social media is melting down over the latest development, that's when you need to block out the chaos and focus on fundamentals. If a business depends on political favors, be careful. Any company whose success relies on having the right people in office, on getting specific regulatory treatment, on maintaining political connections, that's a fragile business model because politics change, administrations change. What works today might not work tomorrow. The governor, gets replaced by someone else. The regulatory officials who were friendly get replaced by people with different priorities. And suddenly the entire foundation of your business model has shifted. If a business depends on unpredictable regulation, be careful. When a company's profitability hinges on regulatory decisions that could go either way, you're not really investing in a business. You're placing a bet on how regulators will act. And that's not investing, that's gambling. You might get lucky, you might not, but it's not the kind of calculated risk-taking that builds wealth over time. If a business depends on heroic assumptions about asset value, be careful. When the whole investment thesis requires believing that assets are worth dramatically more than what objective observers might conclude. When it requires everything going exactly right, when there's no margin for error, that's dangerous territory, because things rarely go exactly right. Markets change, conditions shift, assumptions prove overly optimistic. You need businesses that can succeed even when things don't go perfectly, that have enough margin for error to absorb surprises and still generate reasonable returns. If a business uses debt aggressively, be careful. Leverage amplifies everything. It amplifies gains when things go well, sure, but it amplifies losses when things go poorly. And when you're operating in an uncertain legal and regulatory environment, adding aggressive debt on top of that uncertainty, that's a recipe for trouble. Debt has to be serviced, interest has to be paid, principal has to be repaid. And if the business hits a rough patch, if revenue declines or costs increase or legal problems create unexpected expenses, that debt can turn from an accelerator of returns into an anchor dragging the company toward bankruptcy. If management plays too loosely with numbers, be careful. This should be obvious, but apparently it needs to be said. If the people running a company are creative with their accounting, optimistic beyond reason with their valuations, willing to push boundaries on what they disclose and how they disclose it, that's a red flag, a big one. Because even if they haven't crossed the line into fraud, even if what they're doing is technically legal, it suggests an approach to business that prioritizes appearance over substance, that values the story they're telling more than the underlying reality, and that's dangerous. Governance is not a footnote, it is a filter. It's how you separate companies worth investing in from companies that might blow up in your face. The New York case proves that. Here you had a situation where valuations were being presented in ways that a court ultimately concluded were fraudulent, and the consequences, they're real, they're ongoing, they affect how the business can operate going forward. That's not theoretical. That's not some abstract concern. That's actual evidence that governance matters, that how companies present their numbers matters, that courts are willing to step in when they believe lines have been crossed. On the other hand, companies with clean balance sheets, straightforward business models, and honest managers usually weather storms like this. Clean balance sheets mean they're not over-leveraged. They have the financial cushion to handle unexpected problems. They're not constantly scrambling to refinance debt or meet covenant requirements. They can ride out difficult periods without facing existential threats. Straightforward business models mean you can understand where the money comes from. They make something, they sell it, they generate profit. It's not dependent on complicated financial engineering or regulatory arbitrage or any of the fancy schemes that sound great in theory but fall apart in practice when conditions change. When you can easily explain to someone how the business makes money, that's usually a good sign. When it takes an hour and multiple charts and lots of specialized terminology to explain the business model, that's often a warning sign. Honest managers mean you can trust the numbers, you can trust that what they tell you is accurate, you can trust that they're not playing games with valuations or hiding problems or putting their interests ahead of shareholders. They survive legal cycles, political cycles, and news cycles. They keep operating through all the chaos because their success isn't dependent on any particular external factor. It's built on solid fundamentals, on actually creating value, on serving customers and generating consistent cash flows and reinvesting wisely for growth. They survive because their value comes from what they produce, not from how loudly they defend themselves. The product sells itself. The business model works. The numbers speak for themselves. They don't need constant PR campaigns or aggressive legal strategies or political maneuvering to maintain their value. They just quietly go about the business of creating value year after year through good times and bad. Cash still matters. I've been saying this for 70 years and it's still true. Companies with strong cash positions, with the ability to generate cash from operations, with cash reserves to weather difficult periods, those companies have options. They have flexibility. They can survive things that would kill their more leveraged competitors. When a crisis hits, when markets seize up, when credit becomes unavailable, the companies with cash survive and often thrive by buying assets from desperate sellers at distressed prices. The companies without cash often don't survive at all. Patience still matters. The market rewards patience, not timing the market, not jumping in and out trying to catch every swing, but finding good businesses and holding them through the noise, through the cycles, through the periods of uncertainty. Some of my best investments have been stocks I bought and held for decades, ignoring all the day-to-day noise, all the crises and panics and bubbles, just letting good businesses compound value over long periods of time. Discipline still matters. Sticking to your principles, not abandoning your investment criteria just because something looks exciting, not chasing returns, not getting caught up in whatever's hot at the moment, having standards and sticking to them, even when it means passing on opportunities that everyone else is excited about. Often, the best investment decision is the one you don't make, the bad deal you walk away from, the overpriced asset you decline to buy even though everyone else is piling in. These are not old rules. They are permanent ones. They worked in 1950. They worked in 2000. They work today, and they'll work in 2050 because they're based on fundamental truths about how businesses create value and how markets function over time. The superficial stuff changes. The technology, the specific industries that are hot, the names of the companies, but the fundamental principles of value creation, those don't change. Good businesses with honest management, generating cash, and reinvesting wisely. That works in every era, in every market condition, in every regulatory environment. And here is the part many people miss. The part that gets lost in all the headlines about penalties being thrown out or charges being dismissed. The appeals court's removal of the financial penalty did not end the core issue. It eliminated one consequence. Sure, a significant consequence, but it didn't make the underlying problems go away. The monitor is still there, still watching, still reviewing major decisions, still constraining how the business operates. The fraud finding is still there, still on the record, still affecting how banks, insurers, and business partners view the company. The restrictions on borrowing and major transactions are still there, still limiting flexibility, still adding friction to every significant business decision. The Georgia RICO case still exists, still pending, still requiring legal resources, management attention, and creating uncertainty about potential future consequences. These are ongoing, not concluded. The story isn't over, the legal pressures haven't been resolved, the situation hasn't been wrapped up with a neat bow. It continues. It evolves, and it will likely continue evolving for quite a while. We're probably years away from final resolution of all these various legal matters, years during which the uncertainty and constraints and scrutiny will continue affecting business operations. So what does this moment really represent? It represents a shift, a slow, grinding movement in how institutions deal with powerful actors. Not a sudden revolution, not a dramatic overnight change, but a gradual recalibration of what's acceptable, what's enforceable, what consequences apply when lines are crossed. Whether you applaud it or criticize it is your choice. That's a political judgment, a moral judgment, and reasonable people can disagree. Maybe you think it's long overdue accountability. Maybe you think it's politically motivated overreach. I'm not here to tell you which view is right, but from a financial point of view, it tells us that the system is recalibrating, and investors need to understand that and factor it into their thinking, that valuations are being challenged. What used to be considered aggressive but acceptable optimism might now be viewed as fraud. That changes how people approach valuations, how they present them, how comfortable they are pushing the boundaries. That oversight is expanding. Regulators, courts, prosecutors, they're all looking more closely at business practices that might have flown under the radar before. They're asserting jurisdiction, imposing supervision, setting new standards. That courts are willing to take a heavier hand in private enterprise when they believe the public interest requires it. Court-appointed monitors, operational restrictions, ongoing supervision of private businesses, these were relatively rare before. They might become more common going forward. And once institutions shift like that, they rarely shift back quickly. Think about financial regulation after the 2008 crisis. Once Dodd-Frank passed, once all those new oversight mechanisms were put in place, they didn't just disappear when the crisis ended. Some got rolled back around the edges, sure. But the fundamental shift toward more regulation, more oversight, more scrutiny of financial institutions, that remained. Same principle here. Once courts and regulators start taking a more aggressive approach to business practices they consider problematic, once they establish precedents for intervention and oversight, that doesn't easily reverse. It becomes the new baseline, the new normal that future cases are judged against. So as an investor, as someone trying to understand the environment your investments operate in, you need to recognize this shift. You need to understand that the landscape has changed and will likely continue changing in this direction. Does that mean you can't invest in real estate? No. Does it mean you can't invest in companies with complicated structures? No. Does it mean you avoid anything that touches on political or regulatory issues? No. But it does mean you need to be more careful, more selective, more focused on companies with strong governance, conservative accounting, honest management, solid fundamentals that don't depend on regulatory favoritism or creative valuations or any of the practices that are now under increased scrutiny. It means understanding that the margin of safety you might have accepted before might not be sufficient anymore, that the risks have evolved, that the consequences of getting it wrong or of management getting it wrong have potentially increased. And it means recognizing that in uncertain times, in periods of institutional recalibration, in environments where the rules are being rewritten in real time, the safest approach is usually to stick to the basics, to focus on quality, to prioritize businesses that create real value regardless of the legal or regulatory environment. Because those businesses will survive, they'll adapt, they'll continue generating returns for shareholders even as the landscape shifts around them. While businesses built on shakier foundations, on aggressive practices, on assumptions that no longer hold, those might struggle or fail. That's the lesson here. Not that any particular person or company is good or bad, not that any particular legal outcome is just or unjust, but that the environment is changing and investors need to adjust their approach accordingly. Stay close to the basics. Focus on fundamentals. Be careful with leverage, with aggressive valuations, with businesses that depend on things outside their control. Prioritize governance, transparency, and honest management. Do that and you'll weather this storm and whatever storms come next, because the storms always come. But good businesses, well-run companies, investments based on solid fundamentals, they survive. The good news is the American system has survived bigger storms than this, and I mean much bigger. I've been watching this country for over 90 years now, and believe me, we've been through some things. It has handled conflict between branches of government, the executive branch versus Congress, Congress versus the courts pushing back on both, constitutional crises that made people genuinely wonder whether the system would hold together between states and federal authorities, states asserting their sovereignty, the federal government asserting supremacy, battles over jurisdiction and power that have gone on since the founding, between regulators and industries. Every major industry in this country has at some point clashed with regulators, banking, railroads, telecommunications, technology. The fights are fierce, the stakes are high, but the system works through it. It has handled political trials, corporate crackdowns, and messy legal battles. Watergate, Enron, the financial crisis, all the scandals and prosecutions and investigations that seemed earth-shattering at the time. It bends, but it does not break easily. That's the genius of the American system, really. It's flexible enough to absorb shocks, to adapt to changing circumstances, to handle conflicts without shattering. It's messy, it's slow, it's frustrating, but it's resilient. The real risk is not collapse. I want to be clear about that because I know there's a lot of apocalyptic rhetoric out there, a lot of people saying the country is falling apart, the system is broken beyond repair, everything's going to hell. I don't buy it. The institutions are strained, yes. The political environment is toxic, absolutely. But collapse? No. That's not what we're looking at. The real risk is uncertainty. And from an economic standpoint, from an investment standpoint, uncertainty is often more damaging than actual bad news. Because bad news you can price, you can adjust to it. If you know something bad's going to happen, you factor that into your decisions and move forward. But uncertainty, you can't price it accurately. You don't know what to plan for. You don't know whether to assume the best case, the worst case, or something in between. And uncertainty is what pushes investors to demand more for taking risk. When you're not sure what's going to happen, when the range of possible outcomes is wide, you want to be compensated for that uncertainty. You want higher returns to justify taking the chance. And what slows the engine of growth when the future becomes harder to price. When businesses can't confidently project what the regulatory environment will look like, what legal standards will apply, what costs they'll face, they pull back. They delay investments, they reduce hiring, they conserve cash and wait for clarity. And when everyone does that simultaneously, growth slows, not because of any specific bad outcome, but because of the collective caution that uncertainty creates. That is why at moments like this, plain rules matter most. Simple, time-tested principles that work regardless of what's happening in the headlines. Buy what you understand. Don't invest in things just because someone else says they're great or because they're trendy. If you can't explain how a business makes money, how it creates value, what its competitive advantages are, you shouldn't own it. Hold what you trust. Once you've found businesses with solid fundamentals, honest management, sustainable competitive advantages, hold on to them. Don't get shaken out by short-term noise. Don't sell just because the news is scary or the market is volatile. Avoid what depends on unpredictable behavior, whether that behavior comes from CEOs or from courts or from politics. If a business only works if specific people make specific decisions, if it requires regulatory favoritism, if it depends on legal outcomes going a certain way, that's too much uncertainty. That's not investing. That's speculating. I know costs are real. Inflation affects everyone. Interest rates affect everyone. The challenges of operating in this environment are genuine and significant. Risks are real. Legal risks, regulatory risks, market risks, all the things we've been talking about. I'm not dismissing any of it or pretending it doesn't matter. But with discipline, patience, and clarity, you can navigate through both as I have and still am. Discipline to stick to your principles even when it's tempting to chase quick returns or get caught up in whatever's exciting. Patience to wait for good opportunities rather than forcing things. To hold through difficult periods rather than panicking. To let compound interest work its magic over years and decades. And clarity about what you're trying to achieve, what you're willing to risk, what principles guide your decisions. When you're clear about those things, the noise becomes easier to filter out. I've navigated through recessions, through market crashes, through political turmoil, through wars, through all kinds of uncertainty and chaos. The principles that worked then still work now because they're based on how businesses actually create value, not on trying to predict the unpredictable or time the untimable. So while the headlines are dramatic and the legal situations are complex and the political environment is intense, the fundamental task for investors remains the same. Find good businesses, pay reasonable prices, hold for the long term, and don't let the noise distract you from what actually matters. That's how you build wealth, that's how you protect what you have, that's how you navigate through periods like this and come out the other side in good shape. Do well to leave a comment below. I'd love to hear your thoughts on how you're approaching this environment, what concerns you most, what opportunities you're seeing. Let's have a real conversation about how to navigate these times. Subscribe and let's watch out for what happens next, because this story is still unfolding. These legal cases are still developing and the implications will continue playing out for quite a while. Stay informed, stay focused on fundamentals, and we'll work through this together.